Netflix kicked off FANG earnings, or is it Mang now? Start the countdown. Welcome back to the Investor Place Launchpad. We take a look at trending investment ideas and try to rocket them to the moon. I'm Head of Mission Control, Aaron Davis, and this week we're diving into tech earnings, what it is, why it's important, and what you should be on the lookout for. As always, before we dive in, we'd love to continue to grow our channel here at Investor Place, so feel free to hit that like and subscribe button and smash that notification bell to stay up to date with us here at the Launchpad. With all of that out of the way, let's take a look at what to expect with earnings season. Earnings season is a condition set by the Securities and Exchange Commission that requires publicly traded companies to disclose their earnings over the past fiscal quarter, typically kicking off in January, April, July, and October. This helps to provide a better transparency to investors as to what they're investing in and how a company is performing. As we enter the end of April, FANG Stocks, an acronym used to refer to the big five tech giants, Facebook, Amazon, Apple, Netflix, and Google, have been in relative decline, Apple being the exception, with Facebook down 45.3%, Amazon down 13.4%, Netflix down a staggering 64.2%, and Google parent Alphabet down 17.4%. With the Nasdaq overall down 17% year to date, interest rates rising, and a potential recession looming, investors have been shying about from high growth stocks in favor of blue chip securities. Cue the downtrend in tech stocks. The case for strong earnings is paramount in the decline to stay in investors' good graces. However, as we witnessed with Netflix, weak earnings can lead to devastating sell-offs such as the one we saw over the past week. Last Friday saw Pershing Square's Bill Ackman selling his entire stake in Netflix in an open shareholder letter. Ackman had purchased 3.1 million shares in late January for around $1.1 billion and sold them for an approximate $400 million loss, reducing Pershing Square's year-to-date returns. This came to a shock to some investors as Pershing Square held onto its position for only 3 months, with the hedge fund typically holding onto a stock for more than 4 years. This seems to be a direct result of Netflix's poor earnings report, where the company stated it had lost 200,000 subscribers over the course of the first quarter. In Ackman's open letter, he does not condemn any of Netflix's proposed plans, which include a potential ad-based model subscription service. Rather, he sees it difficult to gauge the effectiveness of increased advertisements on the company's long-term subscriber growth, future revenues, operating margins, and capital intensity. Ackman explains how Pershing Square likes to focus on businesses with high degree of predictability. With Netflix's new model of targeting non-paying users, Ackman says the firm is no longer able to predict its business prospects with a, quote, sufficient degree of certainty, end quote. However, Ackman isn't necessarily bearish on Netflix. He also stated the following: based on management's track record, we would not be surprised to see Netflix continue to be a highly successful company and an excellent investment from its current market value. With the big Netflix earnings miss still fresh in investors' minds, should you be nervous about big tech companies on deck to report this week? Investor Play contributor Joel Baglole looked at 7 of the top tech stocks reporting this week and concludes that one way or another, the market will be moving as these leading tech companies report their Q1 results. For the full breakdown of Baglole's analysis, you can head on over to investorplace.com, but Baglole surmises the following things to be looking for with these tech giants. Microsoft is working to conclude a $68.7 billion gaming acquisition. Alphabet has underperformed following a stock split announcement. Meta Platforms is looking to recover from the largest single-day drop ever. T-Mobile is building out its 5G network following its acquisition of Sprint. Apple continues to make waves with updated hardware. Amazon is on track to be the largest U.S. delivery service this year, and Intel is expanding its chip production capabilities. Baglole's examination of Amazon looks specifically at its new direction as a delivery service, from allowing online merchants to use its Prime service to deliver goods to customers around the world as direct competition to UPS, FedEx, and the United States Postal Service. With Amazon stating it's on track to become the largest delivery service in America by the end of 2022, it will be interesting to see if the company can bounce back from its 13% dip year to date, and if its earnings report April 28th will be enough to kickstart a rising tide. Earnings season will always be an indicator of what to expect in the short-term prices within a company, at least until the next earnings season. While the start of 2022 certainly hasn't been what many expected, earnings season helps put the market into perspective. But what do you think? Is earnings season a good indicator of what the markets will do? Are FANG stocks the only earnings we should be paying attention to? And what earnings are you interested in? We'd love to hear your thoughts in the comments section below. Well, that's all we have in the Launchpad this week. If you'd like more insights like this and Joel Baglole's full breakdown of the 7 tech stocks reporting earnings the week of April 25th, head on over to investorplace.com where we release articles daily. And as always, check back with us here at the Launchpad where we will continue to look at trends like earnings season. And as always, try to shoot for the moon.